Hey everyone, another week has gone by, another successful week trading options, and fortunately the CPI numbers were okay and it didn't have a major impact on the market. In fact, the volatility continued going down. As we can see over here on the daily chart, the volatility was up around the $24 mark and now it's sitting at 18, below 18 and a half. So that did a lot of good for options traders, but now we're in an environment where the risk is actually much higher. If we jump over to the SPY, the S&P 500 chart, we can see that the market jumped up over 5% in the last few days and the volatility completely collapsed. We're at levels we haven't seen for a very long time. So that's actually a risky environment for us, and I explain it to you in this diagram. So as we can see, when we're in a low volatility environment and we sell a strangle around one standard deviation, then we are relatively close to the mean, to the average or the middle line of the price movement. So for those of you who are new to options trading or not really familiar with it, when you sell a strangle, what it means is that you sell a put option and a call option expiring at the same time, and that's what we call a strangle. And for those of you who are not familiar with statistical terms, one standard deviation represents 68.2% of the cases. So in this diagram, we have a 68.2% probability that the price is going to remain between our dashed lines. But when we're talking about a high volatility environment, then our dashed lines or one standard deviation is much wider. It's much further away from the middle line of our price movement. So if you put those two together, then you can see that when you're moving from a low volatility environment, you sold these options, and then the price swings start to become wild and the volatility jumps up, then that's a red flag. That's when your brokerage firm would require you to put up more capital, and you are at a much greater risk of being tested on either the put side or the call side by the price movement. So that's a pretty high risk for options traders. Therefore, it's very important to make sure that we have sufficient level of capital put aside. I would recommend minimum 50% of your total buying power on your trading platform. So that's something to consider. Now let's take a look at my trade number 223. So for those of you who are new to my channel, I document one of my options trades every single day for your benefit so you can learn from it. So today I sold a strangle against Wayfair. Over here, as we can see on this graph, this is the daily chart. I drew a channel in here at $55 and $30, and the price has been fluctuating in this channel since September. So it's a pretty wide and stable channel. And what happened in the last few days, the price gone up from about 31 all the way to 43. So now we're right in the middle of that channel. So I decided to sell a strangle against it. The volatility is relatively low, but unfortunately that's quite common across the board at the moment. So I was looking for a trade which was relatively safe. I mean, this is a pretty wide strangle. I collected just over $2 credit for it, and I sold the February expiration. That's because the next earnings is scheduled to come out on the 23rd of February. So I sold the $30 put option and the $55 call option. So that gave me $2, just over $2 credit. The buying power that it uses at the moment is about 865. So it gives me a fairly high potential ROI of 247 if I keep it till expiration, but normally I don't keep it till expiration. The other trade that I did today was an adjustment on my SPY position. For those of you who have been following me, you know that I have a strangle against SPY and some of the other index funds, and that's because that's my anchor, that's my safety net, because they don't fluctuate as much as individual stocks. So I had the 365 put option and the 410 call option, and I moved up my put option a little bit closer to the current price and collected an additional 41 cents credit. So I've got a lot of credit in this deal because I initially opened this trade on the 20th of May last year, and I have the intention to just keep rolling it for forever pretty much. So that concludes my trade number 223. I hope you find it useful. I hope you find it beneficial. Once again, please keep it in mind that when we're in a low volatility environment, then it's actually higher risk for options traders. So I hope you find this useful. Please hit the like button, subscribe to my channel, and spread the word. And I'll see you on the next video. Thank you for watching.